Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the latest edition of Carson's Facts versus Feelings with Ryan and Sonu. This one is happening literally as the Emmys are on, so I'm not sure if Sonu's paying attention to anything other than his beloved...
Iowa caucuses too.
Iowa caucus. We'll explain why in a second. We're doing working on a Monday night here, and there's some football on too. Anyway, this is episode 68, sponsored by White Charts. We're titling this one "The Little Things May Add Up." There's a lot. We were coming up with a title. We're like, there's a bunch of little things happening, and those little things could become big things, and then we're going to touch on those. But you mentioned you're a big fan of The Bear. I've never watched it. Apparently, the time you and I are recording Monday night, it's cleaning up. You want to talk about that, Sonu?
Yeah, as far as I know, last I checked, which is probably a few minutes ago, The Bear's cleaning up at the Emmys. It's already got like 5 Emmys: Best Drama, Actor, Supporting Actor, Supporting Actress. No, it's a show about. I like to think about show about the restaurant scene, the gritty restaurant scene in Chicago. And as you and I know, as you know, and probably a lot of our listeners know, I'm a big fan of food and food in Chicago too. So the show hit the spot. I mean, for me, it's an amazing show. I definitely recommend watching it. I'm a big fan of Succession as well. So this is The Bear is sort of beating out Succession, but Succession's already won over the last several years. And I know you like Succession too, right?
Oh, yeah, I loved it. Yeah, I thought it was great. I thought it was it's just hilarious. I guess it's a lot of times the stuff that they got into. But anyway, so we're doing this. I'm traveling a little bit this week. It's early in the year. Got some partner events on the West Coast, and I'll be flying on Tuesday, the normal time we do this podcast. So Sonu and I are going to give this a shot on a Monday night. Well, we don't have our producer, Chelsea, here, so if we run off the rails, you know what happened. Don't it's our fault. We didn't have Chelsea to rein us in. Yes. But there is a lot of different things like we talked about, Sonu, that you and I wanted to talk about. These kind of some little things. Again, we're titling this one, "The Little Things May Add Up." We're going to start talking a little bit about the geopolitical scene out there, right? I mean, you've got the Red Sea issues. You've got Taiwan floating out there. Maybe we'll come up with another one as you and I are chatting. Go take a look at inflation. There was a lot of inflation last week. Rates 2-year.
Yes.
Continue to move lower. We'll talk about that. Then finish it up with some myths. There are some popular questions coming in that we've busted, I think, before, but we're seeing them again. And we're going to take a look at 2 recent, we're going to say myths that are out there that are scaring investors. And we're going to show why you shouldn't be so worried about them. So again, we'll start with the geopolitical scene. I guess we'll start with the Red Sea. Last Thursday evening, I'm about to go live on TV with Brian Sullivan to talk about our recently released Outlook, which hopefully, if you had a chance, you've listened to the Outlook that we discussed last week on the Facts versus Feelings podcast. You can go to carsongroup.com as well. And what is it? carsongroup.com /
insights.
It's economic/outlook. Pretty sure economic.
There may be a hyphen there. Yes, economic hyphen outlook.
What's the thing that goes sideways, like a minus sign? I'm going to call it a minus sign. Is that a hyphen? It's late on a Monday. Yeah. So, but there's lots of places you can find our Outlook all over social media. We've had a lot of positive feedback, and so definitely check that out and let us know. I got sidetracked. Oh, that's what it was. So I was on TV with Brian, and literally like an hour before I was on, the U.S. and some of our longtime partners, we started fighting in the Red Sea because of all the different things. And I'm not going to pronounce the Houthis. Houthis, apologies. That's been bubbling around for a while, but then for years, but I mean, I guess it's more lately. So you see the prices of, shipping things around the globe starting to go higher, mainly because of that particular area. It brings back inflation, which we'll talk about next, all these different worries. And it's like, will it spiral out of control? Will it not? Is it just the U.S. being, the global cop that it has to be in a lot of cases with our friends to kind of clean up some of these problems? We're no experts in this field. I will say, oil sure spiked a good deal on Friday, and energy stocks as well. You want to talk about some of what you're seeing so far with all of that, Sonu?
Yeah, so the Houthis are basically an Iranian-backed militia and based out of Yemen, right? They're they're in Yemen and fighting for, Yemen's had issues for a long time. And there's
Mhm.
been this sort of like, conflict with Saudi Arabia, Houthis on one side, Saudi Arabia on the other side. So it's been bubbling for years now. And then lately, they started attacking
Yep.
ships that go through the Red Sea. Why is the Red Sea important? Because the Red Sea connects it to the Suez Canal. And so
Mhm.
many ships, look, if you're transporting goods from Asia to Europe, the easy way is to go through the Suez Canal, as opposed to otherwise, you have to go through the Horn of Africa. You have to take
Yeah.
that whole detour underneath, right?
For a
And a lot
long
of
way.
ships,
Mhm.
yeah, that's a
Mhm.
long way. That's what they used to do before the Suez Canal, right? So that's why it's a critical thing. And the Suez Canal, what you and I were just talking about last year,
Mhm.
remember that big, massive ship got stuck in between, and then,
Yeah.
things couldn't go, prices were high. But the other thing is, like, I'm a macro strategist. You can always look at geopolitics. There's always something to worry about.
Mhm.
And frankly, even with respect to oil, a lot of oil obviously comes from the Middle East. And for oil, the critical sea passageway is really what they call the Strait of Hormuz, which is actually what connects the Persian Gulf to the Arabian Sea. That's a little
Mhm.
north of the Red Sea. It's not the Red Sea by itself, right? Which is not to say this is not critical because so many goods go through there, but I think it's more
Right.
critical for Europe more than anything else because a lot of ships carry stuff from Asia to Europe. Whereas for us, remember that whole thing where there were 20, 35 ships off the coast of Long Beach? So many of
Mhm.
our stuff comes from Asia, and that comes via the Pacific Ocean. So unless, Hawaii or the Polynesians decide to do something, I mean, hopefully, it won't send prices stateside spiking too
Mhm.
much. But that's still something to keep an eye on. And, another little thing that could become a big thing. So
Or
far, no, maybe.
you're right. And again, I think what you pointed out was such a good point because we have a lot of investors listening to this podcast, a lot of new investors, financial advisors. Every year, even some of the most bullish years in history, have had issues. There's always been fear. There's always been worry. I mean, I'm pretty sure it was 1914 was the greatest rally ever in the Dow, like up 86%. That was World War One. Okay, I mean, so
Mhm.
there are some. We're not minimizing what's going on and
Right, right.
these potential
Absolutely. Yeah.
hiccups that could become bigger issues, no question. But again,
Mhm.
every year, I mean, just last year, right? Last year, look at the headlines. I mean, those headlines last year, look at the Michigan consumer confidence, most of the confidence numbers we've seen last year in the midst of a roaring bull market that we saw last year,
And
like
remember in
literally one of the,
October,
yeah,
right?
yeah,
The Middle
oh
East
yeah,
conflict in October. And suddenly we're talking about oil.
hmm
We had an amazing guest, one of our own advisors,
yeah,
Matt Carmel, on. And,
hmm
he's fantastic about talking about this. And like, that was almost like the high point for oil. And since then, oil just went, all the way down from
yeah,
$95 a barrel to about $70 a barrel. It's gone up, like you said, on Friday, it went up
yeah, a
after
little
the
bit.
strikes.
Yep.
But there are so many other things. I mean, like you said, this is not to minimize conflict or political conflict, whatever it is. Those things are important in their own way. But with respect to markets, I mean, don't be surprised if markets surprise you. I guess that's the way I would put it.
I could buy a T-shirt that says that. I kind of like that. Don't be surprised if markets surprise you. That's true. So that's the Red Sea. Obviously, it's happening. We're watching it very closely. Well, I mean, again, Sonu and I are by no means are political experts in any of this, but we pay attention to it. And we've got Taiwan, which has been in the news on and off repeatedly for quite a while. Is China going to potentially invade? We don't really think so, but Taiwan had their election recently. President Biden's in the news about Taiwan. I mean, that's still swirling out there. Hadn't really impacted. Well, you know what? I mean, literally, I saw a stat, Sonu, the Chinese stock market's down 3 years in a row for the first time in history. Now, I don't know if that's because of the Taiwan conflict. There's probably some other things, but that's lumped in there. I mean, there's some things going on in
Yeah.
China that simply aren't really working. We've mentioned on this very podcast, we don't really like EM because we don't really like China, right?
Yeah.
EM X China, maybe there's opportunity there. We just haven't really been warm and fuzzy on China, and then you see us down 3 years in a row for the first time ever. That tells you something. What are you seeing about Taiwan and how it impacts China, or China impacts Taiwan, however this squared circle works?
I think China's got. I mean, by the way, this is another time to put up our outlook because we talked a
Yeah.
little bit about China and outlook. We are overweight the U.S. We are overweight stocks, but we like the U.S. more than because you think growth in the U.S. will exceed everywhere else. And China is the second largest economy in the world. So when you talk
Yep.
everybody else ex-U.S., obviously China is a big piece of that. China's been slowing for a long time, quite a few years now. And if we could spend a whole episode in China. Maybe that's something to talk about. We can save it for later. But China's got a lot of issues, right? With debt and, the real estate bubble that's burst basically, and how that is such a big factor in its economy, the real estate market. But Taiwan, yeah, Taiwan just had its election. Every time Taiwan has an election, I feel like this comes up because, whoever wins the election, especially the last time, the person who wins the election, if they're antagonistic to China, then, suddenly there are Chinese battleships in the Straits of Taiwan. And then everyone's talking about, oh my God, is China going to invade, right? Even this time. So Taiwan's current vice president is Lai Ching-te. He won with, he won about 42%, something like that of the vote. By the way, that's the lowest winning percentage since 2000, right? His ruling party, which they lost its majority in the legislature. So actually what happened, there are three parties. The two other parties, one is Kuomintang, Taiwan People's Party. They got a little more power. And so they've been in the camp of like, we should keep talking to China. Whereas the person who won, he didn't win a majority, by the way. He's a little more antagonistic to China, right? So I think all in all, it comes back to like, we've got status quo. That's what it is. Status quo with respect to Taiwan. Xi Jinping, the premier of China, he's still like, Taiwan belongs to us. And in fact, for that matter, even the U.S. agrees, right? The U.S. basically, U.S. policy, official U.S. policy for decades has been like, Taiwan is officially part of China, and we do not support Taiwanese independence, right? So that's like a given. I mean, it's nothing new. It's just that, look, I think China has a lot to lose if they invade Taiwan. They're not going to do it anytime now, especially when the economy is I would say the economy is in trouble. They were growing at 8-10% in the 2000s. That slowed to 7-8% in the early 2010s, closer to 6% before the pandemic. Now they're probably closer to 4-5%. So they've been slowing. That's a big slowdown, right? Last year, I think the U.S. economy in nominal terms would have grown faster than the Chinese economy. I'll just put it at that.
So is that official data yet? Did the U.S. grow faster than China?
Not yet.
It's not official, but it is,
not official.
There's a chance. It's
yeah,
close.
And especially when you think about nominal GDP, especially nominal GDP is real GDP plus inflation. We had some inflation. China was in deflation. So, but still, when you look at the size of the economy, we always talk about the nominal economy, right? $28 trillion for the U.S. economy. I mean, that's all nominal numbers. But it's still amazing to think that U.S. economy would have grown faster than the Chinese economy last year.
Again, we don't want to talk about sports too often on this podcast, but for all you Cowboy fans out there, you had deflation in your score in your playoff game the other day. That was a little shot. Somebody told me that. I know. Sorry, America's team makes me mad. It's not America's team. Nobody even likes the Cowboys. Everybody hates the Cowboys. The Texans, an Ohio State boy at a quarterback, they're still playing. So take that, Dallas. Anyway, all right, enough of that. I'm tired on a Monday night. If I'm a little feisty, sorry. I just don't like the whole America's team. Like, win something, Come on now. Come on. Anyway, all right. Where we're going now, I just probably isolated half of the listeners. Apologies.
By the way, we're talking about geopolitics. Does the SEC getting hacked count as geopolitics?
Yeah, we're going to talk about that in a little bit here. Yeah, we've got the. I was going to make a joke about your Twitter was hacked or something there. Yeah, that's another one. Well, let's finish that up. I mean, anything else on the Red Sea, China, before we kind of go on to some other things that are out there? Sonu, mention?
These are always things to watch. I mean, then suddenly you say, "Oh, North Korea fired a missile again," and
that's true. Good point. Yeah.
So, I feel like that's somewhere always around the corner, right? I mean, again, I do not mean to minimize it. These are serious things. I mean, I don't mean to laugh at it, but look, like I said, markets don't expect markets to treat these things the way initial reaction may look like, right? So things may always pan out differently.
No, absolutely there. So, we'll talk. Let's go there. Let's go to the Bitcoin ETF taking place, right? The SEC did eventually, and it was talk about some drama. There was some drama getting there where where does that stand, by the way? They said that their Twitter was hacked. I don't believe it. I still think an intern sent it too early. I'm not saying I know anything that no one else knows. I mean, did they really get hacked? Where's that even stand on Monday night, Sonu? Have you followed up on it? It seems like they're trying to push it away. It honestly seems like they're just trying to say, just forget about it. Just forget about it. We said we were hacked. We weren't really hacked. I don't know. I don't buy it.
I mean, it makes sense, right? Like if you're a big organization or something like that, you have a tweet or whatever ready. Your press release. Your press release in today's world is your tweet, right? That's ready to go. Somebody just hit the send button. I mean, we joke that as an intern, it probably could have been someone higher up, right?
It probably was. Yeah. It
No,
was their
they
first
said,
tweet. It was their first tweet ever. They got a little excited. Yeah. There you go.
now they said what was one thing they said was interesting is like some person got access to their account and they didn't have two-factor authorization. I mean,
Right.
like I don't
Now,
know, whatever.
I will say this. So, do you use two-factor for your Twitter or X? Do you use it by chance? I don't. I
I
probably should. I don't know.
I don't know if I should be. We should be saying this, but
That probably is true.
Yes,
That's a good point.
something
Never
else.
mind. I've got it. I use it every time. Never mind. By the time you listen to this, I'll have turned it on. When I saw it, I was like, I always have that alert. I'm like,
will
whatever.
we get into trouble with IT if we say something we're not supposed to? No, I
don't know.
You know,
I guess we'll find out. I told you, Chelsea wasn't here. I knew we'd do something stupid. I knew we'd get in trouble one way or another. Anyway, so 11 different ETFs were approved. It was coming, right? I don't think it was a shock. Again, the drama of getting it out there was one thing. The one thing that gets me, because you think about cryptocurrencies, we're somewhat limited to what we can say here, but you say, when the ETF comes out, remember when there were Bitcoin futures? I forget exactly what it was, but that was near like a major peak in Bitcoin. Yeah. Now, the one that got me was GLD, right? Gold ETF. Right. The gold ETF came out on November 18th, 2004. You remember back to that time, gold.
Okay, wow.
Yes, gold went up in 2005, 2006, 2007, 2008, 2009, 2010. I believe 2011 was the peak. So just because this major ETF comes out, again, I'm not making a call. I'm just pointing out that, doesn't mean that, it has to stop the some of the strength. I believe in these cryptos, some strong, some aren't. We get it. But again, I think this was something that was coming. I mean, Sonu, again, we don't probably want to talk too much into this, but I mean, these ETFs that are out there, does it make sense for some investors? It's a little safer now, I guess, than just doing a wild, crazy coin on a phone that could disappear, right? I guess.
Or a phone you lose your password to, I suppose.
Oh, yeah, that's true, too. You didn't do the double thing, and there you go. Yeah.
You don't have to have two-factor authorization.
That's what I'm trying to say, yeah.
No, look, I mean, Bitcoin's volatility is so high, right? Like it's got 2 or 3 70% pullbacks. I mean, it's crazy to think 70% pullback last 3 years, and it's still, it's turned a lot. I mean, like you said, we're not making a call or anything, but one thing to think about these things is like, okay, if all of us have some level and tolerance of risk. Yours may be different from mine. Actually, both of us may be kind of the same. But for whoever's listening here, your risks are, talk to your advisor, right? Like if you think about a moderate portfolio, think about 60% bonds, 40%, or 60% stocks, 40% bonds, right? It's got historically over the last several years, volatility, as we call it, about 12%, right? I mean, I'm not going to get into how that number is, what exactly it is, standard deviation, things like that. Right. 12% volatility. You add like 4% Bitcoin in there, right? And then that volatility goes up to about 13%, right? And it's only 4%. And out of that 13%, like little over a tenth of that comes from Bitcoin, right? Now, if you add 10%, to your 60-40 portfolio, right? Suddenly your portfolio volatility goes from 12% to 15%. Now, you may be okay with it. You may not be okay with it. But again, this is just something to talk to your advisor about when you're thinking about, should I allocate to Bitcoin? Do I want to allocate to Bitcoin? What is the risk of there's so many different questions I recommend you ask your advisor about.
Yeah, but I guess the bottom line is it's a little bit easier for investors. Yes. And I forget the quote. Oh, I wish I had the quote. Just the SEC's quote about it. They pretty much said, you know what? You guys made us do it. We're telling you, it's risky. Don't blame us if this thing has another 85-90% drop. We didn't want to do it really, but they did it. But anyway, so that's where it is. So
it's a bit of trying to have it both ways, if you ask me. Like with the SEC, I don't want to get into trouble here.
Well, exactly. But you know what? There's a little more easy. It's a little easier for people to get into it if they want, and in theory, it's a little bit safer as well when you've got big names connected to the ETF. So that's out there. Update on my back. We talked last week. My back was really messed up. So we're doing this on Monday. So it was 12 days ago. I bent down picking up some Christmas lights outside. It was cold and the back locked up and hurt. And I went to Dr. Steve, Mount Lookout Chiropractic, and he's got me back. I'm ready to got me back. Nice. No pun intended. I'm ready to go do a somersault, Sonu. I don't know. I feel so good right now.
Valentine's Day lights now.
Yeah, well, that's true. That's true. And I might not. We do a little bit of Valentine's Day, but I don't know if I have any lights. But but I do feel
No
better
lies.
because you and I were talking. I'm the next 4 days I'm on 6 different flights. Like I have all these different connecting flights and different things. So I'm flying all over the place. I said, "Ooh, this would not be a good time to have a back," and my back feels pretty good. So anyway, so
You
we'll
come
see.
back
But,
and set up an appointment with Dr. Steve as soon as
I've
you
already got one.
land.
I've already got one. He said you should probably get. I know. It's like the next day I land, I'm going to go get him. He's going to snap me around a little bit. All right, so let's talk about inflation and rates. Really, inflation. I mean, last week some of the bigger stories. Well, actually, again, let's reiterate here. Remind everybody. Episode 68, sponsored by Y Charts. The little things may add up. So there's lots of little things that are out there. I don't know if inflation's really a little thing, but it's not as we're not having these wild daily swings. Remember when CPI would come out? 5, 6, 7, 8 months ago. Those were like the most volatile days ever. CPI came out, PPI came out. Market, hey, we were up last week. I mean, stocks are up. I know the small caps are down a tad, but S&P had a good week. Tech, really, if you look at last week, it was like tech communications with the two leaders, like almost a rerun of the previous year. But that makes sense because they had this kind of a weak-ish start. Which one do you want to talk about first? CPI, PPI, mix them together? What do you want to do?
Yeah, we'll mix it together. I mean, it feels like we're back to regular order now with talking about inflation because, we spent the last year talking about inflation. The CPI for December, it's literally the last CPI report for 2023, right? And CPI came out. Turns out inflation was 3.4% in 2023, year over year, right? But that hides a lot of things, right? It hides the fact that, when you're taking 3.4%, I was thinking about that's year over year, and like, oh, that's high. But the denominator in that number is the denominator from December 2022. We're a long way off from that, right? And for whatever reason, that could be low, high, and like, why, do you really want to look at a 12-month number, right? When you're concentrated on like, oh, what's happening more recently? Well, it turns out over the last 3 months, headline inflation, CPI, 1.8% annualized pace, right? Over the last 6 months, it's running at 3.3%. But wait a minute, you and I have talked a lot about shelter. Shelter is a third of headline CPI. It's 40% of core CPI once you strip out food and energy. If you strip out shelter, keep food and energy, everything else in there. Strip out shelter, right? Because last 3 months, inflation is flat or 0.1%. Annualized pace, not even like month over month. It's annualized, right?
Wow.
Last 6 months, it's running at 2.3%. Last 12 months, it's running at 1.8%, right? This is if you strip out shelter. And then PPI comes out. And what happens is like suddenly everyone looks at the PPI. Why is PPI important? Yes, it's, PPI is measures prices businesses charge each other, retailers, wholesalers, things like that. But actually, why for most practical purposes, PPI is important because a lot of data from PPI goes into PCE inflation, and the Fed follows PCE, right? So what happened is the PPI data was soft for December, but that told us that PCE inflation is going to be quite a bit softer than CPI, right? PCE inflation in December is going to be up 0.2% month over month. Right. And over the last 3 months, if you look at PCE inflation, once you get it's going to be up 1.6%, right? 1.6%, right? Core PCE, if you strip out energy and food, which is what the Fed, says they care about, and 1.9% over the last 6 months. So basically, in short, the inflation problem is pretty much over. And that's why the Fed, as soon as this data came out on Friday, this was last Friday, PPI data came out, suddenly the markets are pricing the odds of a March rate hike at about 65%.
Well, time out. You said rate hike. You meant cut, just to make sure.
Oh, rate cut. Yes.
I know. That's all right. That's all right. Hey, that's why it's a two-man operation. I say stuff all the time that doesn't make any sense. You correct me. So I'm helping you here. No problem. Rate cut. March cut. Yep.
March cut odds were about 65%. As soon as the PPI data came out, people say, you know what? We're going to take those odds up. The odds of a rate cut in March went up to 80%. And the market's now back to pricing in about 6 to 7 cuts in 2024. Now, if you ask me, I think that's a little ahead of itself. I mean, Fed officials over the last week, it seems like they're still uncomfortable with talking about rate cuts. Forget when they'll cut and how much they'll cut. They're not even like entertaining the idea, at least publicly, about rate cuts. They're like, yeah, inflation slowed, things like that. We're happy with it. All they're saying is we're not going to hike rates anymore. I think the market's like, goodness, come on, get a grip, people. Like we're well past that, and they're pricing in a March rate cut. I don't know if I would put the odds of a March rate cut at 80%. I'm still maybe 50-50, 60-40, maybe. I don't know. There's still more data to come. That's all I'll say.
No, well said there. I mean, just looking at some of the notes I wrote to myself, PPI's been down month over month, 3 consecutive months. So again, that's something you don't see every day. What else did I have here?
I think if everyone listening, PPI is producer price index.
Yeah,
so that everyone knows.
Level.
CPI is consumer price index.
Here's what I want to ask you, Sonu, as I was looking at these two, and correct me if I'm wrong, but I think I've got it right. What I read on Thursday when CPI, the consumer level, came out, energy was a little higher. Now, on Friday, they told us energy was down 1.2%. How, I don't even, if you had a chance to even look into this, how in the world is that possible? How's energy up for one of them and down on the other? I know it's the consumer level, producer level. Maybe it's that simple. It just struck me as I was looking at the data for both of them that they showed different numbers on energy, even though they're the same month and they came out a day apart. Did you get a chance to look at that by chance?
Yeah, the first thing I'll say, both of them have like seasonal adjustments, which can make results.
Of course, they all see that's such a cop out. The seasonal. That's you know what? That's probably who sent that tweet out for the SEC. The seasonal adjustment guy. That's probably who did it. Just blame him.
And then for CPI, it was a little harder on the side because under energy, it's not just gas prices. Gas prices we know have been coming down. Yeah. But because seasonal adjustments, if gas prices are up like 0.2% or something. Again, not a huge amount, but considering the previous 2 months it was down, that was like a bit of a reversal. Electricity prices were up. I think that's what pushed up consumer energy prices higher a little bit. I look at electricity prices, but they, again, it could be just a seasonal adjustment thing.
Yeah. We've done 68 of these, and 68. That was the one question. So you know what? I bet I'm going to stump him because I ask you stuff all the time. People think this is scripted. This is not scripted. I just come up with stuff. That was the one I said I'm going to mess with him, and he's not going to know the answer. And you just maybe you don't. And when we stop it, record, say BS that one. But there's a pretty good answer for not knowing.
No, I did. I did look at it. I was surprised, to be honest, that I was like, I saw the energy number for CPI. I was like, wait, this looks a little hard. So I did stare at it for a few minutes, thinking, like, I wonder what's going on there.
So one other thing, we've talked about this before. Inflation matters. There's no question about inflation matters, but also what consumers think about inflation matters. Because in the 1970s, consumers continue to expect higher inflation, and it can have that kind of self-fulfilling prophecy even into the early 80s. The New York Fed, which does a survey, and yes, it's a survey, but we're still going to pay attention to it. Their survey of their consumer survey came out, Sonu. 1 year inflation is, according to the New York Fed, only 3%. Prior 3.4%. That's the lowest since January of 21. And the 3 and 5 year inflation expectations also dropped. So again, overall inflation is coming down, but what the consumer expects inflation to do is coming down. I mean, that's why we're going to see some rate cuts, right? Is it that simple?
I think so. That's it. I mean, it's really as straightforward as that. And look, with respect to rate cuts, I mean, I think there was a big debate this weekend even over PC versus CPI. And there's never what is true inflation? I mean, if you think about CPI, okay, a third of that is rent, right? And it's really rent. There's owner's equivalent rent, which is like you and I are homeowners. It's as if we're renting to others. Really doesn't make any sense, but they have to measure it, right? It's like when I own a home, what the government, BLS, Bureau of Labor Statistics, treat that as like I'm providing myself a service. So I'm sort of renting to myself. And then they're not looking at home prices. Home prices are not in the CPI. Right. Instead, what's in there, it's all rents. It's like if I'm renting to myself, they look at, okay, what is my neighbor renting their place for? Right. That's how they get their rents. And, if you think about 66% of American households own homes. So in a sense that rent doesn't even apply. A third of the CPI index is rent. It doesn't apply to the majority of American households. So whatever.
And odds are they'd give themselves a pretty good deal if they're renting to themselves. I mean, I'd cut myself a deal. That'd probably be disinflationary by itself if you think about it. Anyway, so good points. And speaking of like your home and stuff, my daughter passed her driver's test on Friday. Susanna officially, so she drove for 6 months with the permit. Where I'm sitting next to her, yelling at her about stop and do stuff and. Yeah, we got into it a couple times on that, but she officially passed her driver's test on on Friday, and she's been it's weird. Like today, I was taking one boy to one practice, the other boy had another practice, and then Susanna had had some. Even though it's Martin Luther King MLK Day and the day off, they still have all their practices and stuff. Doesn't really matter. School's still got stuff going on, even though there's no school. And she
Can she take the boys now?
Well, she could, but she just took her car and went to her own cheer practice, and it just was weird. Wow. It's just weird. I don't know, it's just weird. Like, where's Susanna? Oh yeah, and then she went and got her nails done the other day. She's going to Starbucks. I'm like, you need to get a job. This is going to cost me a lot of money. It's going wherever you want all of a sudden here.
In addition to insurance, I imagine.
Yeah, that's just supposedly going to double. I don't have the official numbers yet. My insurance guy, he knows everything. I've turned it all into him, and it's coming like Friday,
but
Monday.
You got two boys coming out.
Yeah, apparently boys cost more because they're worse drivers if you look at the statistics. So we'll see. You've got 1 and 1, but you're like 10 years away, right? Your kids are 6, right? 7.
They're 7. Yes.
Yeah. So you've got a minute.
Time.
Got a minute.
I'm just going to tell them to take the train. Here's a card. Go punch it in. That's
living in Chicago. I don't blame you. So we've got one more thing we wanted to kind of dive into, some myths that we're going to talk about. Before I go there, two of the greats on literally back to back, Bill Belichick and Nick Saban, both out. Believe me, maybe they'll show. I think Saban looks like he's really retired, but Belichick, it seems like he might show up again. Who knows? Maybe over in Dallas.
Really?
For all my little rant there. But those two, I didn't know this. Those two combined won 13 championships, 7 Super Bowls for Belichick, and 6 titles for Nick Saban. 5 at Bama, and I guess it was 1 at LSU. I assume is how that worked out. Or no, he had 7. Well, yeah, he had. Sorry, Saban had 7, and Belichick had 6. Comes out to 13 total. I'm getting at. Pretty amazing. Just lost some greats.
On that track, and then it's a little underrated, right? Like you just mentioned it just hit me that over the last decade, you think about I'm a tennis fan. Obviously, you think about Nadal and Federer and Djokovic and all, really dominant in the thing. And then you think about Tom Brady, whether you like him, hate him, whatever. You think about, him dominating, and then there's LeBron James on one side. But until you mentioned Saban and, Belichick, I mean, they were really dominant, 13 between them. It was really the era of those two, the last decade probably, right?
Yeah, it really was. And I saw a stat that Belichick has 1 playoff game without Tom Brady in his career, and they lost by 30. So apparently it does help to have a generational quarterback. Go figure. All right, enough of that. Sometimes we get feedback. You guys talk too much about sports. We try not to, but I just thought it was interesting with some great leaders and some truly historic figures have potentially moved on. So congrats to them on some amazing careers. All right, so 2 myths, and we've been hearing this from our Carson partners because their clients have been bringing it up. I've seen it out there. M2, which we're going to dive into. M2 is back in the news, and then we're seeing some things about the male labor participation rate continuing to be much lower than it was, this time in the 70s and 80s. Which I'll be honest, I hadn't really seen that because I see the other participation rates we're going to talk about here, and it surprised me. So let's start with M2. The Fed has flooded the system, as they tell us, with M2, but year over year, M2's come back drastically. Apparently, the last 6 or 7 times, M2 year over year has come back to negative. We've seen a recession like every time. We heard this a year ago, or felt like almost the last year, but it's in the news again. This is sort of a little bit more of a confusing discussion. We'll try to keep it high level, but why do you think M2 being negative year over year this time is not the I don't know, just not going to lead to a lot of trouble like it has, several times in the past?
I would say like last year, it didn't lead to trouble. So that should be a first sign that, we're well past that. So I think that's proofs in the pudding, but I should probably define what M2 is, right?
Yes.
It's a measure of money for everyone who's saying M2 is like a measure of money. You have, if you've seen those Russian dolls, I forget what exactly they're called. You pull one out and there's another one. You pull another one. Those Russian dolls. That's what the measures of money are like. You start with M0, which is like currency in circulation plus reserves. Reserves is basically what banks lend to each other. Let's set aside why and how they do that. That's M0. Then you have M1, which is M0 plus all the money in checking accounts, for example, right? And then M2 is M0 plus M1 plus savings deposits, time deposits like CDs, things like that, and then money market funds, right? So as we've seen, there's been a ton of money that went into money market funds, all of that. And what we've seen is that M2 has actually come down. Historically, M2 coming down has been associated with slowing inflation. Now, we've gotten that last year, but it's also been associated with a slowing economy. One thing that confounds M2, especially over the last decade, is that because the Fed is doing quantitative easing, and now it's doing quantitative tightening, that's messing up the M2 figures to no end, right? So I wouldn't even, you know what? Essentially, I'm measuring, okay, how much money is going into the system, into the US economy. M2 is measuring that. It's saying that, you know what? If M2 is coming down, that means there's less money in the system. That means the economy is not growing, right? It's kind of like, in very simple terms, that's what it is. That's what people are worried about. But like I said, the Fed buying bonds and now not buying bonds anymore for their portfolio, US Treasury bonds, that's messing up the M2 figures. Instead of that, look, if you're thinking about like how much money is in the system, just go to where money is created. And I know we are talking about Bitcoin, right? Everyone talks about like Bitcoin, money, all of that. Actually, and you think, oh, money is created by the government. Actually, a lot of the money that's created in our economy is created by banks. If you go to a bank, get a mortgage, or I go get a mortgage, they're not really or if I go to the bank, it's like, oh, I want a loan to buy a home. They're not looking, oh, Ryan Detrick put, how many ever thousands or hundreds of thousands, Ryan, into his bank account. I'm going to take that money and lend it to you. No, that's not how banking works, right? They say, you know what? You want a loan, we create money. Literally, the act of making a loan is the act of creating money in our system. Most of the money in our system is created with bank credit, right? So if you, instead of looking at M2, you just look at bank credit, and that's running along fine right now. Right. And so even I could spend a lot of time talking about money creation. Essentially, money is credit in the economy. It's a credit note, right? It's created. When banks give you a loan, what are they doing? They're creating a deposit that's in your bank, and then you use that money to go pay for your home, right? That deposit is actually the bank's liability. At the same time, they have an asset. That asset is a loan, right? Because I'm paying them interest, things like that, right? I mean, so that's essentially how money creation, for the most part, most of the money in the economy is created through the banking system, right? So I think that's where, instead of looking at M2, just look at bank credit creation. It slowed a bit because, like you and I have talked about over those last cycle, why do we avoid a recession? That's because incomes are strong. It's not because credit growth is slowing, all of that, yes, but incomes are strong. This is an income-driven cycle as opposed to credit-driven cycle, right? Another reason why, I'm not too worried about M2, to be honest.
Yeah, well, good stuff there. I'm gonna boo. I'm just trying to wake everyone awake. I think everyone just fell asleep on that, but no, teasing. No, it's important. I mean, I'm trying to make it a joke, but I mean, believe me, if we follow social media, and it is out there again, it is some very prominent bears are bringing up M2 once again as a reason to be worried. I mean, believe me, we're watching it. We're not ignoring it, but like Sonu just said, I mean, yield curve. We didn't really plan on talking about the yield curve. We've had the inverted yield curve since April 1st. You can't make it up. 2022, very long time now. The yield curve's been inverted, and we have not seen that recession, that bear market that so many people have been promising us. The LEI, leading economic indicators, we've talked about that before, 20 months in a row now, negative month over month. And it just continues to, the old playbook for what used to be a recession or would always, quote unquote, lead to a recession simply hasn't yet. It may be eventually. PMIs, but you have a recession like every 5 years. So you look at this stuff long enough, you're eventually going to, that's on average, believe me, no such thing as average. We get it. But still, recessions happen. We're going to have another one. It's going to happen. So you just look at this stuff long enough, you're randomly going to have one. But these things that so many bears have just tried to trot it out so many times simply hasn't been working. One other myth, though. What was it? So, this one I just started noticing this weekend, right? The male labor participation rate is drastically lower than it was in the 70s, 80s, 90s. And the worry is people aren't working. People aren't working according to this as much as it seems like. We keep talking about this full employment backdrop. Then you see this particular chart, and it kind of throws that on its head. You want to talk about why you're not so worried about that one?
Yeah, amongst other things. I'll have to go back and listen to this episode and think, like, what was I thinking? Like, did I give the right explanation there? Or maybe I'll have to just remind myself of it.
Again, we didn't have our producer. We're doing this on our own on a Monday night. It's apologies if we're going off the rails a little bit, but maybe you liked it. Maybe it's fun. Maybe it's fun. Yeah.
It hopefully tells all of you listening something about ourselves that we're doing this on a Monday night. But
with the Emmys, when the Emmys are on, there's a playoff game, the Eagles game. I don't know. I actually might want to look. What's the Eagles score right now? It's happening as we speak. So yeah.
All right. So labor force participation. I'll try to keep this short. For men, look, in the 70s, 80s, it was around 75, 80%. And that's come down to below 70%, maybe around 66, 67%, something like that right now. So it's a big drop, right? Especially if you shrink the y-axis, it looks like a crazy drop. I mean, it's significant, right? Now, one thing I should mention, what is labor force participation, right? It's a labor force as a percentage of the working age population, people above the age of 16 years old, right? Now, what it measures obviously people working, but it also measures people actively looking for work. I put that in quotes for those of you looking at, not watching this on YouTube, right? Now, for various reasons, a lot of people tend to fall in and out of that actively looking for work category. The other thing is demographics. We have an aging society. A lot of people fall off that, right? A better measure, and Ryan and I have talked about this before, is the employment population ratio. This gets around definitional issues as to, like, it just counts number of people working as a percentage of the working age population. And then you look at, okay, to avoid the demographic issue, you look at ages 25 to 54, which is prime working age, right? And that's how you get around the fact that we have an aging society. For males, that's around 86.1%. That's not far from the peak level we saw over the past 2 decades. Now, it's lower than what we saw in 1999, when it was about 89%. By the way, for women, prime age employment population ratio is close to 75%. That's an all-time record, right? Yes, our employment population, the percent of people working, especially males, has gone down a little bit. But I think part of that had to do with what happened after the 91, 2001, 2008, 2009 recessions. After each one of these, we still had what we call slack in the labor market. We didn't get back to a tight labor market very quickly. And, participation never made it back to the prior cycle peak. And that's because, you don't want to blame the Fed all the time for this sort of stuff, but still, I mean, part of it was maybe, rates were too high, right, at that time. And because of that, and then labor was cheap as well as a result. And, we talked about productivity not rising over the last couple of decades. All of this stuff goes together, right? What do you need for productivity? We talked about this in the Outlook. You need businesses to invest. Now, if labor is cheap, why would business invest? You can just, hire labor for cheap. Now, I think the current situation is actually different. I mean, as you and I talked about, and especially in the Outlook, we think this is a tight labor market. We think that environment of the last 2 decades has changed. As labor gets more expensive, businesses are incentivized to invest, right? And because of that, productivity is likely to go up. We've seen that over the last few quarters. That's a positive story. But I think the fact that, like female employment population ratio, prime age, is at all-time record highs to tell you more than enough about, how, quote unquote, good this labor market is actually.
I mean, so if the prime is what, 25 to 54, is that correct? And that is near one of the highest levels in decades for males. Yeah, if you look at all the males out there, it is well off the highs. I mean, is it as simple as people are living longer and they're just retired? I mean, is it that simple, or is there a little more to it than that? I mean,
I mean, participation goes down, like the number of people as you age. I mean, obviously the people are retiring, and so if you think above the age of 55,
we just had 2 coaches retire. We talked about it, right? I mean, there's 2 more. Oh, they've got enough money to do it though. I guess Nick Saban's got a $17 million house like over in Tiger Woods neighborhood down in Florida, so he'll be doing okay. I think. Yeah, he'll be all right. He'll be all right. He'll be all right. Yeah.
But employment population ratio, if you look at above the age of 55, that's going to be much lower than the prime age, right? Because, a lot of people are not working, right? Even if they can, they're retired. And then if you think of we have an aging society, so there are more people in that category in the first place, right?
Right.
And that's why you see like labor force participation. If you take for the entire, 16 years to whatever, to the highest level possible, it's gone down, over the last 40, 50 years. But so anyway, that's all.
Yeah, good stuff. I mean, these are some what we would say myths, and they're out there, and definitely we like to give our opinion on those things there. I mean, Sonu, a couple more things. We're pretty much at the end of the road here. Earnings season is obviously kicking off. Some of the financials, the banks, but some of the bigger names, the different areas, going to be reporting in the next 3 to 4 weeks. How do you see earnings kind of playing out?
I think so far so good. I mean, again, I say that with literally one day of earnings, but
Hmm.
you have the bank earnings, right? Why the bank's important? I mean, the banks are the intermediate. It's literally talking about
Yep.
money in the system.
Right.
They're the ones making loans, right? And we're talking about loan growth contributing. That tells you that the economy is growing. If more people want to take out loans to invest, create houses,
Hmm.
whatever, right? So that's going positive. And I think Jamie Dimon, for everything else he says or not says about the economy,
Right.
his company is doing fine, right? His company is doing fine. I mean, I think several banks have come out and said that the consumer is fine. I mean, you
Right.
and I have been saying that for a while. It's nice to hear confirmation, though.
Hmm. Yeah, Jamie Dimon, he likes the mic in front of him. You never know what he's going to say, but he obviously leads a very, very successful bank, one of the largest banks in the world. Obviously, I think they were hitting all time highs like just last
Mm-hmm.
week, right? One other thing that caught my attention, obviously, Boeing's having their issues with their 737 Maxes with the doors and potentially some issues there.
Oh,
But I saw the headline. I think it was was it Sam Rowe? We'll give Sam credit. I think it was Sam who shared this, but if not, Sam, I'm mentioning your name anyway. Someone mentioned Airbus had a record 2,094 orders last year. What in the world does that mean? The previous most orders Airbus has ever had was about 1,500 exactly 10 years before. So it's a 39% jump in the number of orders for Airbus. Airbus airplanes. I mean, that's, again,
that's
things
a
you
lot.
probably wouldn't see in a recession. If people are ordering
Yes.
that many planes, I think that would caught my attention in a big way. Also, congrats! I've got to hear some of the exact numbers. Microsoft overtook Apple for the most valuable company in the world. Here it is. Microsoft
Really? I
two.
didn't know that.
Yeah. See, there you go. You're slacking, Sonu. You're slacking. $2.89 trillion. Isn't that just an amazing number for Microsoft?
Wow.
Apple's worth $2.87 trillion. I believe that was as of Friday. So, by the time you listen to this, it'll be a little different. But that's just kind of amazing. The size of these. I mean, again, I don't have the numbers in front of us, but $3 trillion. That is more than a lot of countries out there. Like a lot of very significant countries that are out there. We've got companies in this great country that we live in that are worth that much. So anyway, congrats Microsoft. But Apple's not going to give up yet. I'm sure they're going to keep going at it. Anything else, Sonu, you want to talk about before we wind down this special Monday? The last time we do one on a Monday night without Chelsea to rein us in. We've been going way too long. I can already tell, but sorry. Anyway,
I think we've gone long.
Yeah.
I mean, I think I've said enough with M2 and labor force participation, so I'll just stop there.
Yeah, I'm still half asleep when you talk about M2. That was so boring.
I may be half asleep too.
I know. All right, so everybody, we are recording this on MLK Day, right? So obviously a lot of people had the day off. I wanted to get a quote by Martin Luther King Jr., and here I found this one. I scribbled it, so I hope I don't mess it up. My writing's so terrible sometimes. He said, "If you can't fly, then run. If you can't run, then walk. If you can't walk, then crawl. But whatever you do, you've got to keep moving forward." I thought that was pretty cool. And obviously, he has
That's cool.
Tons and tons of really good quotes, but that's one I've kind of heard before. Maybe you've heard it before, but I think it makes sense in this world we live in, and this investment. I mean, of course, we're investments. We talk about investments on here, but just in life, right? Just keep moving forward, keep investing, keep going. The Churchill quote. If you're going through hell, keep going. Kind of like that, right? Just keep on moving. And with all that, I guess we're probably going to sign off on episode 68 of Carson's Facts versus Feelings with Ryan and Sonu, brought to us by our friends at Y Charts. The little things may add up. So with all that, everybody, give us a like, give us a follow. We appreciate it. And we will see everybody next week, assuming they let us do one of these again after after we went off the rails a little tonight. We'll see everybody next time. Take care. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.